Welcome to YCC Capital Macro Research. We don't follow headlines, we follow the data. Every day, we analyze the world's largest economies, financial markets, and geopolitical developments to uncover the structural forces shaping tomorrow's investment landscape. Let's begin. The U.S. labor market has long been the single most important variable shaping Federal Reserve policy, and by extension, global financial markets. While headline payroll numbers often dominate the news cycle, they rarely tell the complete story. A truly comprehensive assessment requires examining labor demand, labor supply, wages, participation rates, hiring activity, layoffs, and forward-looking indicators together. In today's report, we'll walk through 19 key indicators that reveal where the U.S. labor market stands today, whether inflationary pressures are continuing to ease, and what these trends imply for future interest rates and the broader macroeconomic outlook. The first chart places today's unemployment rate into nearly 8 decades of historical context, while comparing it with the level associated with the Federal Reserve's long-run inflation objective. Historically, recessions have almost always been accompanied by a rapid increase in unemployment. Whether during the oil shocks of the 1970s, the early 1980s tightening cycle, the global financial crisis, or the pandemic, unemployment typically rises dramatically once economic momentum deteriorates. Today, however, unemployment remains remarkably stable around the level implied by the Fed's estimate of price stability. The dotted line highlights the unemployment rate, broadly consistent with a 2% inflation environment, and current readings remain very close to that benchmark. This tells us something important. The labor market is no longer overheating, but neither is it collapsing. Instead, the economy appears to be transitioning toward a more balanced equilibrium, where labor demand and labor supply are gradually moving back into alignment. This is precisely the type of adjustment policymakers hope to achieve without triggering a recession. While risks certainly remain, history suggests that as long as unemployment stays near this equilibrium level instead of accelerating sharply higher, the probability of a soft landing remains significantly higher than many investors feared only a year ago. To understand why unemployment has remained relatively stable, we need to look beneath the surface at the balance between labor supply and labor demand. This chart compares the available labor force with total labor demand, measured as employment plus job openings. The gray bars represent the difference between supply and demand. During the post-pandemic reopening, labor demand dramatically exceeded available workers. Businesses competed aggressively for employees, creating one of the tightest labor markets in modern history. That imbalance fueled rapid wage growth and persistent inflationary pressure across the service sector. Over the past 2 years, however, this imbalance has steadily disappeared. Job openings have declined, hiring has normalized, and labor supply has continued expanding through both higher participation and increased immigration. Today, the labor gap has essentially closed. This is one of the clearest signs that the labor market has normalized without experiencing a sharp deterioration in employment itself. Rather than businesses suddenly firing workers, they've simply become less aggressive in recruiting additional employees. That distinction matters because slower hiring is far less damaging to economic growth than widespread layoffs. For Federal Reserve officials, this represents an ideal adjustment. Inflationary labor shortages have eased while overall employment remains historically resilient. The next chart reinforces this normalization by examining labor force participation. Participation measures the share of the adult population that is either working or actively seeking employment. In many ways, it represents the economy's productive capacity. Following the pandemic, participation collapsed as millions of workers left the labor force due to health concerns, early retirement, childcare challenges, and changing work preferences. Since then, participation has recovered significantly, although the pace of improvement has slowed considerably. More recently, participation has begun drifting lower again after reaching its post-pandemic peak. The year-over-year growth rate has also steadily weakened, suggesting that the rapid expansion in labor supply observed over the past 2 years is beginning to fade. This development carries two implications. First, slower labor force growth means future employment gains may naturally moderate even if hiring demand remains stable. Second, a slower increase in available workers could eventually limit how much additional disinflation the labor market can generate. In other words, one of the major forces helping ease wage pressure over the past 2 years may gradually become less powerful going forward. Nevertheless, current participation levels remain substantially healthier than many economists initially expected during the pandemic recovery, contributing to the overall resilience of the US economy. Having established that the overall balance between labor supply and demand has largely normalized, let's look at one of the most closely watched indicators of employer confidence: job openings. During the reopening boom, companies raced to hire workers at an unprecedented pace. Job openings surged to record highs, reflecting not only strong economic activity, but also widespread labor shortages. That period has clearly ended. The level of job openings has declined steadily from its peak and has now returned to levels that look much more consistent with historical norms. Equally important, the year-over-year growth rate has climbed back toward positive territory after spending an extended period in contraction. This combination tells an encouraging story. The labor market is no longer in free fall, but neither is it overheating. Employers have adjusted their hiring expectations to a slower, more sustainable pace. Think of it like easing off the accelerator rather than slamming on the brakes. Companies are no longer desperately searching for workers, but they also are not aggressively eliminating positions. For the Federal Reserve, this is exactly the type of moderation that helps reduce inflationary pressure without generating unnecessary economic damage. Hiring is only one side of the equation. The other side is layoffs. The Challenger Job Cuts report tracks announced corporate layoffs and often provides an early indication of changes in business sentiment before they become visible in official employment statistics. Over the past several years, announced layoffs have experienced several temporary spikes, particularly in sectors undergoing restructuring, such as technology. However, what stands out today is that both the monthly level of announced layoffs and the year-over-year growth rate have moderated considerably from previous surges. Large headline layoff announcements often receive disproportionate media attention, but the broader data suggests these events remain concentrated rather than economy-wide. Most industries continue to retain workers because replacing experienced employees remains costly, and firms remember how difficult hiring became during the labor shortages of 2021 and 2022. This explains one of the defining characteristics of the current cycle. Businesses have become cautious about expanding payrolls, but they remain equally cautious about reducing them aggressively. That behavior helps explain why unemployment has remained relatively stable despite slower economic growth. Weekly unemployment claims offer perhaps the timeliest snapshot of labor market conditions. Initial claims measure how many workers are filing for unemployment benefits for the first time, while continuing claims track those who remain unemployed and continue receiving benefits. Historically, recessions begin with a sustained rise in initial claims, followed shortly afterward by an even larger increase in continuing claims as unemployed workers struggle to find new jobs. That pattern has not emerged. Initial claims remain comfortably within their normal historical range, despite occasional weekly volatility. Continuing claims have drifted somewhat higher, suggesting that job searches are taking slightly longer than they did during the exceptionally tight labor market of previous years. This distinction is important. Workers are finding it somewhat more difficult to secure their next position, but businesses are not initiating widespread layoffs. The labor market has clearly become less dynamic than it was during the reopening boom, yet it continues to display remarkable resilience by historical standards. Unless both claim series begin trending materially higher for several consecutive months, the data continue to argue against an imminent recession driven by labor market deterioration. Instead, they reinforce the narrative of gradual normalization. Another subtle but highly informative indicator is the average number of hours employees work each week. Before companies resort to layoffs, they usually adjust working hours. Reducing overtime or shortening schedules is far less disruptive than terminating employees, making average weekly hours an effective leading indicator for future payroll trends. Looking at this chart, average weekly hours across the economy, manufacturing, and the service sector have all softened from their post-pandemic highs. However, the decline has been gradual rather than abrupt. Manufacturing hours remain under some pressure, reflecting weaker industrial activity and softer global demand. That's not surprising given the slowdown in goods consumption after the pandemic and the ongoing weakness in several export-oriented economies. Meanwhile, service sector hours have been considerably more stable. Since services account for the overwhelming majority of U.S. employment, this resilience has helped prevent broader labor market deterioration. The key takeaway is that employers are managing labor costs primarily through modest adjustments in hours rather than widespread reductions in headcount. That is another hallmark of a soft landing environment. Companies are becoming more efficient without signaling a collapse in demand. Beyond hiring and layoffs, employee behavior also provides valuable insight into labor market confidence. This chart tracks total job separations alongside voluntary quits. The quits rate is particularly important because workers generally resign only when they believe attractive alternatives are available. During periods of strong labor demand, employees become more willing to change jobs in search of higher wages or better opportunities. At the height of the post-pandemic expansion, the quits rate reached levels never seen before, reflecting extraordinary confidence among workers. Today, that optimism has moderated considerably. The quits rate has declined back toward its pre-pandemic range, while the overall separation rate has also eased. This tells us that labor market confidence has normalized rather than collapsed. Workers are becoming more selective about changing employers, and businesses are experiencing less turnover. That naturally reduces wage competition, since firms no longer need to bid aggressively to attract or retain employees. For inflation, this is encouraging. Lower voluntary turnover reduces upward wage pressure, which in turn supports continued moderation in service sector inflation, one of the Federal Reserve's primary objectives. Having examined the labor market itself, we can now connect these developments to monetary policy expectations. This chart summarizes the interest rate path currently implied by CME futures markets. Market participants expect policy rates to remain relatively stable over the coming quarters, with only modest adjustments priced into the curve. Perhaps the most striking feature is how flat the expected trajectory has become. Just 1 year ago, investors were debating whether the Federal Reserve would need to deliver aggressive easing to offset an impending recession. Today, those expectations have largely disappeared. Instead, markets increasingly expect a higher for longer policy environment. Why? Because the labor market has remained resilient, inflation has gradually moderated, and overall economic activity has slowed without collapsing. That combination gives policymakers considerably more flexibility. Unless incoming labor data deteriorate meaningfully, the Federal Reserve can afford to proceed cautiously rather than rushing into large interest rate cuts. For investors, this means future market volatility may be driven less by recession fears and more by the precise timing of incremental policy adjustments. The next chart translates the market's interest rate expectations into meeting by meeting probabilities. Rather than predicting a single outcome, the CME FedWatch tool assigns probabilities to different policy rate ranges at each Federal Reserve meeting. Immediately following the latest payroll release, the market continues to assign the highest probability to only gradual policy adjustments. There is little expectation of aggressive easing or a rapid return to the ultra-low interest rate environment that prevailed before inflation surged. As we move further along the meeting calendar, probabilities gradually spread across several rate ranges. That widening distribution reflects uncertainty rather than conviction. In other words, investors increasingly believe that future Fed decisions will depend heavily on incoming economic data. And among all economic indicators, labor market data remain the most influential. If payroll growth stays healthy, unemployment remains contained, and wage growth continues moderating, policymakers can afford to move slowly. Conversely, if labor conditions deteriorate unexpectedly, markets are already positioned to price in additional easing relatively quickly. The key message from this probability matrix is that investors are no longer expecting dramatic policy swings. Instead, they anticipate a Federal Reserve that remains patient, flexible, and firmly dependent on the incoming data. Government employment deserves special attention because it has become an increasingly important contributor to overall payroll growth. This chart breaks total government hiring into federal, state, and local governments. The most noticeable feature is that recent payroll gains have been driven primarily by local governments rather than the federal government. Local governments continue expanding employment in education, public safety, transportation, and municipal services as staffing levels recover from pandemic-related shortages. Meanwhile, federal employment remains comparatively stable and contributes far less to overall payroll growth. This distinction matters because government hiring has provided a meaningful cushion for the labor market at a time when private sector hiring has moderated. However, investors should also recognize that government hiring is unlikely to remain an unlimited source of employment growth. Budget constraints, slower tax revenue growth, and changing fiscal priorities could eventually reduce this contribution. As a result, sustaining healthy payroll growth over the next year will increasingly depend on continued resilience in private sector hiring rather than government expansion alone. One of the defining features of the post-pandemic labor market has been the rapid expansion of the foreign-born labor force. This chart compares labor force participation between workers born outside the United States and native-born workers. Over the past several years, the foreign-born labor force has expanded significantly faster than the native-born workforce. Immigration has become one of the largest contributors to overall labor supply growth. This increase has helped relieve many of the labor shortages that characterized the immediate post-pandemic recovery. By increasing the available pool of workers, stronger immigration has reduced upward pressure on wages, while allowing businesses to continue expanding without facing the severe staffing constraints experienced in 2021 and 2022. Meanwhile, the native-born labor force has grown much more gradually, reflecting slower population growth and demographic aging. These demographic dynamics will likely remain an important structural theme over the coming decade. Absent continued immigration, labor force growth would slow considerably, limiting potential economic growth and placing renewed upward pressure on wages. For policymakers, the expansion of labor supply has played a significant role in achieving a better balance between labor demand and labor availability. It has helped cool inflationary pressures, not by weakening the economy, but by expanding productive capacity, one of the healthiest ways for inflation to decline. Having examined labor supply, let's now turn to wages, because wage growth remains one of the Federal Reserve's most closely monitored inflation indicators. This chart compares average hourly earnings with inflation-adjusted or real hourly earnings on a year-over-year basis. During the inflation surge, nominal wages accelerated sharply as employers competed aggressively for scarce workers. However, inflation rose even faster, meaning that real wage growth turned negative for many households despite larger paychecks. That dynamic has now reversed. While nominal wage growth has continued to moderate, inflation has cooled even more rapidly. As a result, real hourly earnings have returned to positive territory, allowing workers to gradually regain purchasing power. This represents an important shift in the economic landscape. Households are once again seeing their incomes grow faster than consumer prices, supporting consumption without requiring another surge in wage inflation. From the Federal Reserve's perspective, this is exactly the outcome policymakers hoped to achieve. Wage growth remains healthy enough to support household spending, but no longer appears excessive enough to sustain broad inflationary pressures. In short, the labor market continues to generate income growth, while inflation is becoming less of a drag on consumers' purchasing power. Year-over-year data provide the broad trend, but monthly wage growth often reveals turning points much earlier. This chart compares monthly changes in average hourly earnings with monthly changes in real earnings. The data show that monthly wage growth has become much more stable than during the volatile post-pandemic recovery. Most monthly increases now cluster around a pace that is broadly consistent with the Federal Reserve's long-term inflation objective. Real earnings, however, continue to experience somewhat larger month-to-month fluctuations because they are influenced not only by wage gains, but also by short-term movements in consumer prices. Despite this volatility, the overall message remains encouraging. Neither nominal nor real wage growth suggests that inflationary pressures are reaccelerating. Instead, wage gains appear to be settling into a sustainable range that supports consumer spending without creating a wage price spiral. For investors, this reduces the likelihood that the Federal Reserve will need to tighten policy again, simply because of labor market-driven inflation. As long as monthly wage growth remains contained, policymakers can continue focusing on maintaining overall economic stability rather than fighting a renewed inflation shock. The next chart provides a more detailed look beneath the headline wage numbers. By breaking wage growth down across individual industries, one of the most striking observations is that wage growth has become considerably more balanced than it was during the immediate post-pandemic recovery. Instead of seeing broad-based acceleration across nearly every sector, today's heat map shows a mixture of stronger and weaker industries. Information and financial services continue to post relatively firm wage gains, reflecting ongoing demand for highly skilled workers. Construction also remains relatively resilient, supported by infrastructure investment and continued activity in selected areas of the housing market. By contrast, manufacturing wage growth has become much more moderate as industrial demand softens. Retail also displays comparatively weaker momentum, reflecting slower consumer spending growth and a more cautious hiring environment. Overall, this broad dispersion suggests that wage pressures are becoming increasingly sector-specific rather than economy-wide. That distinction is important because broad-based wage acceleration typically poses a much greater inflation risk than isolated strengths in a handful of industries. Today's data therefore reinforce the broader narrative we've seen throughout this presentation. The labor market is transitioning toward normalization rather than overheating again. The US labor market is entering a new phase. The extraordinary imbalances created by the pandemic have largely been resolved. Labor supply has expanded, job openings have normalized, wage growth has moderated, and inflationary pressures continue to ease. Most importantly, this adjustment has occurred without a significant rise in unemployment, a rare outcome by historical standards. While growth is clearly slowing, the data continue to support the view that the economy is moving toward a more sustainable equilibrium rather than an abrupt downturn. Of course, risks remain. Future inflation, productivity growth, fiscal policy, and global economic developments will all shape the path ahead. But based on today's labor market data, the evidence continues to favor gradual normalization over recession. As always, we'll continue monitoring the data, not the headlines, to identify the structural trends that matter most for investors. Thank you for watching YCC Capital Macro Research. If you found this analysis valuable, please like this video, subscribe to the channel, and visit yccinvest.com/research for our latest in-depth macro research and investment insights. We'll see you in the next report.